All right, hello everyone. This is Clint Lee for the Bauman Letter, and today we have your next edition of Your Money Matters. Joined today by Ted Bauman, editor of the Bauman Letter. We want to take the chance to go through the recently concluded, just signed Phase 1 trade deal between the U.S. and China, and really get into the details of what this means for the U.S. and Chinese economies now, and where we see opportunities, and where we might see some drawbacks as well. So Ted, if you would you be able to take us through just an overview of what's contained in this Phase 1 trade deal?
Sure, Clint. Glad to be back this week. First of all, I think this is very much an interim trade deal. This is primarily, in a sense, a truce. The United States is suspending its threats regarding tariffs on Chinese imports, and in response, the Chinese have agreed to import around $200 million worth of U.S. goods, primarily agricultural and energy. There are a few other interesting tidbits included in the trade deal that I wasn't aware of, which present some opportunities. But overall, I think essentially it is a truce rather than a final agreement.
Now, you mentioned 200 billion additional purchases. That's the number that jumped out and grabbed my attention too. It's been all over the headlines. When I started digging through and looking at the stats of trying to frame that up historically, in 2017, just before the trade war started, Chinese imported about 186 billion or so from the U.S. So that 200 billion in additional purchases, that's more than double what they were purchasing from us in 2017. I guess my question would be, does China even have the scope to come in and make these additional purchases? And does the U.S. have the ability to produce that much to meet that demand?
Well, that's an excellent question, and I think the numbers that I've seen are really loaded towards the agricultural and energy sectors in terms of U.S. exports to China. So whether or not the 200 million figure is reasonable is one thing, but look at this chart that shows the average Chinese imports from the U.S. in agricultural commodities from 2013 to 2017. It was around 22 billion, and the figure I've seen is 40 billion. That's the goal. So you're looking at almost doubling exports, what they were prior to the trade conflict arising. Now, the bulk of those exports were soybeans. So somehow, U.S. farmers are going to have to ramp up their production of soybeans to really historically unprecedented levels. Now, I think they can probably do that, but I do think maybe that this number is a bit of a spin, the 40 million. That may not actually be the real target. I think it's something that it may be politically motivated. The Chinese can certainly purchase as much of whatever they want from anywhere in the world. They won't have a problem buying it. I don't think they'll have a problem using agricultural goods, but there are question marks over whether the U.S. farmers can actually produce them. Nevertheless, it's really good if you make tractors, diesel engines, if you make the parts that go into grain silos and all that kind of stuff. Somebody somewhere is going to make a lot of money. The next chart I want to show you actually relates to the liquid natural gas exports. A big chunk of the Chinese commitment is to buy more U.S. fracking oil and liquid natural gas. Now, as you can see, the U.S. has never been a big supplier. It was always a really third-tier supplier, a little bit above Russia, but significantly behind Australia and Qatar. The U.S. has now basically become a very limited supplier. But the trade deal says that the U.S. is going to ramp up its exports of energy to, I think, 60 billion was the figure I heard. So again, the Chinese can certainly buy and use all of that energy. Whether the U.S. can produce it is another question. We probably can. The big question for me is what happens to global markets in agricultural commodities and energy when the U.S. is directing so much of its output to one particular trade partner.
So you mentioned farm purchases, energy purchases. Those were areas that kind of stood out to you immediately. But what I'm curious about is when you started digging into the details of this agreement, was there any sectors, any opportunities that you see that are kind of flying under people's radars right now?
Well, absolutely. I mean, in addition to investing in maybe the downstream companies that supply the agricultural sector and the energy sector here in the U.S., there's one very interesting thing that I wasn't aware of, and that is that the Chinese are relaxing their regulations over foreign financial equity investment in Chinese corporations. Now that means that Wall Street can basically start directing investment money directly into Chinese companies, including those, for example, in the technology sector. And as we've seen, the Chinese learned an important lesson in this conflict, that they are vulnerable on the technology front with Huawei and all this other stuff. So I think the folks on Wall Street are going to be popping champagne bottles, celebrating the fact that they can now start investing in Chinese technology firms, including IPOs, startups, things like that. And that is something that a lot of people probably weren't aware that that was on the table, but that's coming. The other opportunity, of course, is the Chinese economy itself and Chinese firms. The Chinese government has had a policy target to double GDP from 2010 to 2020. Now, the trade war slowed that process down, slowed progress towards that target. And they've been telling their own people that it's because of the trade war. Now the trade war has been lifted, everybody's celebrating. Now the government has to work hard to make sure that they meet that target, which means they're going to have to stimulate their economy. And that means that Chinese equities and Chinese firms are going to become more attractive for U.S. investors. So those are two things, I think, to look for that may not be obvious to many people.
Now, that's an interesting point, because this trade deal, when you start to go through it, it does seem very one-sided toward benefiting the U.S. And I know even Trump administration officials have come out and have talked about how they expect this trade deal and these additional Chinese purchases to contribute about 0.5% to the U.S. economy this year and next year. But I'm left wondering, how exactly does the Chinese economy come through all this? And you just mentioned that maybe this gives them the path to start to stimulate growth. Can you elaborate on that just a little bit more?
Well, absolutely. I mean, I think the first thing is that this is definitely not a major win for the United States. I would characterize this as a truce for the two. I think both parties have realized that the costs, both economically and politically, of continuing the trade war exceed any potential benefits. But remember, the United States started this process not just wanting to change the balance of trade, but also to get China to behave differently as an economic power. And this is not covered at all in this agreement. China is still free to continue subsidizing its industries. It can still pick winners. It can still require U.S. companies to transfer their technology to Chinese partners as a condition of investment. All of these things, we were told, were the key goals of the trade agreement, and none of those have been achieved. So I think the critical thing is to see this, as I said, as a truce that allows both parties to collect themselves, to lick their wounds, and to really focus on things that are non-controversial. I mean, trading agricultural goods and trading energy is not controversial. It benefits both countries. But the much more difficult issues have not yet been addressed. As I said earlier, I think the Chinese government will try to use this agreement to beef up its non-energy, non-agriculture, and non-real estate sectors. Historically, the Chinese have always relied on real estate as a big driver of GDP, but it's very easy to do that. What they're going to do now, I think, is try to focus on developing their technology sector. And they want Wall Street money. They want U.S. technology to do that. So in a perverse way, it benefits the U.S., but not everybody in the U.S. It benefits Wall Street. It benefits technology companies. So it's good for them, good for those of us who invest in those companies. But whether that changes the balance of trade and returns jobs to America is another question.
So I want to go back to a couple things you pointed out. You've called this a truce, not the be-all, end-all agreement. You highlighted that there are more important things that still need to be hammered out. And so when I look at this being called a phase one trade deal, it definitely means we're not done with this yet. It implies that there's more phases to go. So where do you see us going from here in these trade talks?
Frankly, I see this as one of those kind of situations where China and the United States are going to agree that technically they're going to work towards a phase two deal, but we may never hear about it again. I think the U.S. has realized that to get China to change its overall national strategy as a country away from what is really state capitalism is not realistic. The Chinese have chosen a very different path to free market capitalism, and they're not going to give that up for love or money, as they say. I do think that it will continue to be an issue in trade relations between the two countries. But I think what's likely to happen is that the U.S. government will start to impose restrictions on what U.S. firms can transfer to Chinese counterparts. Rather than get the Chinese to do that, they are going to intervene and say, hey, if you're a U.S. company and you're investing in China, we might impose limitations on what you can actually give to your partners. There may also be some limitations in terms of rather subsidies. The U.S. government may decide if the Chinese is going to, for example, subsidize steel production, maybe we'll do that to our own producers. There are a lot of things still to be addressed, but I think the chances are for the next couple of years, both sides are going to say, let's just leave it as we are and get back to what we were doing before we started.
You mentioned there's still a lot of things that need to be addressed. If I'm an investor, and I'm still facing all these uncertainties, even though we have a phase one trade deal in place, there's still things to take care of. There's still tariffs on $370 billion worth of goods that have not been addressed. If I'm an investor, what is your key takeaway on what I should be doing now?
Well, that's an excellent question. I think there are two things. One is don't invest on the headlines. As we've already seen, the headlines are misleading. I don't believe the 400 billion number. I don't believe the numbers for agricultural exports. I think that they are, in a sense, kind of spin to try to get this whole process over with. So don't invest based on that. Instead, what you need to do is invest based on a more refined analysis of the opportunities and threats as this process unfolds. And I think that's precisely why guys like you and me do what we do, why we have things like the Bauman letter, like our Alpha Stock Alert. Our focus is on trying to identify the opportunities and threats that are behind the headlines. And as I've said a couple of times recently, the most important thing is not to invest simply based on the news that flashes up on, your Wall Street Journal headlines and things like that. You need to take a deeper dive. And so my advice would be look for that kind of deeper dive, from the sort of things that we do. There are some great opportunities. And as I said, some of them I didn't even anticipate from this trade deal. Now we know what they are. You and I will be looking for them, won't we? I mean, that's basically what it, and of course we will share them with our readers.
Great, absolutely. Well, hey, Ted, thank you very much for all the insights on this phase one trade deal between China and the U.S. I'm sure we're going to be sharing more developments as they occur, as the next round of negotiations are unfolding, and we'll be sure to keep everyone posted as to our thoughts and the opportunities that we see out there that are being created. This is Clint Lee for the Bauman Letter. Thanks for joining us today on Your Money Matters.